Good afternoon. Come on, here we go. That's right. All right. There's got to be a little bit of enthusiasm in here for something that is as groundbreaking and world-changing as what you're going to be hearing from us today. My name is George Abernathy. I'm the CRO for FreightWaves. It's going to be my responsibility to make sure that you do, in fact, leave here amazed at what is going to be shown to you today. I will give you a little bit of background and go into sort of the business side of what we're going to do, but I want to introduce a couple of my compatriots at FreightWaves, and we'll be available. If I'm going to ask you, if possible, hold your questions until the end. We'll open up for open banter at that point. So let me introduce the two gentlemen with me, and then we'll get going. Tom?
Thanks, George. Hi, my name is Tom Mallon. I'm Vice President of Financial and Trucking Freight Futures Markets at FreightWaves. I've been with the company now for almost a year and a half. My background is commodities, but also market data, where I've ran commodity businesses at the likes of Thomson Reuters, Interactive Data, and most recently at Global View. So welcome, and enjoy the presentation. Addison?
Thanks, Tom. I'm Addison Armstrong. I'm the Executive Director of Futures at FreightWaves. I just joined the firm about 3 weeks ago from JP Morgan, where I ran client sales and marketing for all of our large corporate commodity clients in the United States that traded futures. So that's the reason why I decided to join FreightWaves. I saw a great opportunity in the market, understood who the users would be of this product. So grateful that you're here today to learn more about it, and look forward to your questions later on. Thank you.
Thank you, Addison. So I said my name is George Abernathy. Those guys have obviously demonstrated some of the significant credibility that we have in the markets. Hopefully, I will demonstrate today to you, and my background will help you understand why, from the perspective in the transportation, logistics, supply chain industry, why this is such a good idea. I've been in the business for 30-plus years. I spent a significant portion of that in both the technology side and also in both assets and non-assets. On the non-asset side, I was for 12 years at Transplace, one of the leading 3PL, 4PLs in North America. While there, I'll tell you a little story. While there, I had a relationship with Craig Fuller, who was the founder and CEO of FreightWaves. Craig had envisioned a freight futures market in freight and transportation, and he was talking to a number of his relationships within the industry to find interest and to bounce this against folks to find credibility. And that was about 3-ish years ago when at Transplace I was responsible for managing about $6 or $7 billion worth of freight. And as I want to say, Craig had me at hello. I would have, if had the opportunity back then to participate in a futures market, I would have been very much all over it, with the opportunity to de-risk at least some portion of, or a significant portion of, that portfolio of freight that we had at Transplace. So I've been a believer for a significant amount of time, so the excitement that we have for the launch of the freight futures market on March the 29th down in Freight Alley in Chattanooga, Tennessee, will be the location where this is launched. And again, I want to thank everyone for attending and here, and thank you to the folks from AB InBev for hosting us here. It's a really appropriate location for us to be having the St. Louis location for the Roadshow. So much of what occurs within, I wouldn't say 4 walls. If you go to the other AB breweries, and I've been lucky enough in transportation to do many of them, I could start listing off Baldwinsville and Newark and Tampa and Cartersville and a lot of the places that I've had the opportunity to be. there really are four walls in most of those breweries. There's not four walls here. There's four walls in about 30 different buildings in what is the Mecca here. But think about what they do here, what they produce here, the commodities that are being utilized to produce what they produce here that then is transported to all parts of North America. And that size and scale of what AB InBev and what they do here in the St. Louis facility and their other facilities is a significant amount of transportation. And how does most of it get there? How does almost all of it get there? It gets there via truck. And we'll talk about that right now. So thank you again to the folks from AB InBev for having us here. So I'm going to talk to you a little bit about who we are. I hope that many, if not most of you, are subscribers to FreightWaves.com and have our content. But what FreightWaves is doing is we're trying to build transparency and build that community within freight and utilizing the data and technology that's now available to us because of the ubiquitous nature of cell phones, and we'll talk about ELDs and the like, to be able to look out and project those changes and, most importantly, be able to de-risk the marketplace. And why? Well, why is because we have the ability to empower that freight community that, as I described when I was at Transplace, has really struggled to deal with the volatility and the challenges that are out there in the freight market. I'm going to go into some specifics about that and show you, and really what we're talking about here is there enough scale for a futures market to work? Is there enough volatility for a futures market to work? Is the quality and credibility of the participants going to be there? I expect by the time this next 45 minutes is done, you're going to say yes to all of those. But one thing is clear. A truck will never show up if you leave here with one thing in mind, and it is that Abernathy bloke was able to finally get me to understand that a truck's not going to show up. My job is done. We will talk about how these are financially settled futures contracts. Do not expect that the frozen concentrated orange juice or the corn syrup or the whatever that physical commodity is, and in this case, the truck bumping up against the dock, is what we're talking about. It's not. This is a financially settled futures contract, and for those of us like me who have been around trucks and freight, I was putting cereal into trucks back when I was in high school. It's hard to get truck out of your head. No truck is going to show up. So I talked about it. We need to define what the market size is, and we need to have an understanding of what is the opportunity. So let's try to put into perspective what are those liquid markets, what are the commodities that are significant enough and have enough scale to provide contracts markets with liquidity. The crude oil futures, obviously, back in '83, the OPEC moment, about $421 billion in the underlying industry. The hub natural gas futures, somewhere in the vicinity of about $140 billion in the underlying industry. In electricity, in power, somewhere around $400 billion or so. All of those extremely liquid, extremely successful contract markets. So what does that mean with respect to freight? $750 billion of transportation of the trucking market on an annualized basis. And these numbers are just over a year old, so that $750 billion is probably a very safe bet given the fact that, as you'll see, the trucking market actually grows slightly faster than GDP does. And keep in mind, and those of you who have been in the world of trading, you understand this, that futures trades happen in multiples by their nature. So we're probably talking about, again, defining that we've got enough scale. We've probably got somewhere in the vicinity of $2.5 to $3 trillion worth of opportunity in the theoretical value and the size that we've got here. And also, think about the comparisons that I gave you. Think about the other market sizes that freight is bigger than. It's bigger than petcoke and refined petroleum, bigger than ag, bigger than power, as we described. So if I haven't convinced you yet about scale, I'll get there. There also has to be a comfort or an ability to get to a comfort around trading in freight for those folks who are having commodities that are transported. And as you're seeing here, about 84% of that is transported today have futures traded against them. So there shouldn't be a large leap of understanding or faith other than a truck won't show up. And if I had more FreightWaves people here, they would all say, when I say a truck won't show up, they would be supporting me on that. Other than getting past that level of comfort, there should be a comfort that says, well, if such an overwhelming majority of the commodities that move are already traded, then having freight traded in this way is certainly not that great a leap. And as I described, trucking is the largest mode of transport. There's oftentimes a perception. We hear about, big rail. Big rail. It's very obvious when one is driving and transporting oneself and a train goes by that there's a lot of commodities that are on that train. That big rail is somehow the largest of the modes in the way that goods are transported in the U.S., and that's actually incorrect. You'll see that truck is the largest, and again, in demonstrating that scale and the opportunity for liquidity, truck actually grows slightly faster than GDP does. Let me put into perspective a little bit more around the how significant is the freight industry domestically. 8% of GDP, a larger cost of goods sold than energy in most sectors of the economy. And this one I think should resonate with all of the transportation folks, any of you who are representing shippers. 40% of the S&P 500 have described that the largest risk that they have to their earnings going forward are in the area of transportation costs. Let's think about what happened in 2018. And for those of you in the transportation industry, congratulations on 2018. I can fairly well say any of you who are in the transportation world in 2018, you hit a home run. Your investors are happy, your shareholders are happy, you're happy because of that you took home. You did well at the bottom line. The volatility in the trucking world was significant, and the impact that had on the shipper side of the world was also very significant. A number of these S&P 500 companies in their quarterly earnings from Q2 through the balance of the year had to describe that the reason that some portion of a negative impact on earnings occurred were 100 or 150 basis points based around their transportation costs being higher than expected. And if they were unable to say that they had a really good grasp on what was going to happen in the future, oftentimes that didn't bode well for what's going to happen in in their stock price. And that's really what's so relevant to me from my background and my desire when I was managing other people's freight, 100% of their freight being my responsibility, the capability of de-risking some significant portion of that and being able to address that third bullet point, that I'd be able to have a predictive outcome around where my transportation costs were going to be, would have been significant. So we've talked about scale. Now, in order for there to be activity, you need volatility. And what this FreightWave sonar chart is displaying is the DAT. Folks know who DAT is if you're in the industry. DAT is essentially the Platts of freight transportation. The DAT van freight rate index is shown here over the last 5 years. And I don't need to point out any particular year except to say, what does it show? It shows volatility. If you just want to go into the recent past, back into 2018, you'll be able to see that, yes, there were significant spikes in what DAT covers, which is primarily the spot rates out there. And for those that don't understand the difference between contract and spot, assume that about 80% or so of the freight transportation market is covered by routine or what are called contract rates, but 20%, 2018, more like 30, 35, 40% were covered in the spot market, which makes me much more vulnerable to price increases and my transportation budget being significantly higher than I want it to be as a shipper who wants to have that under control. So we've got volatility. When you look at this slide and what drives volatility, it might be easier for me to tell you or ask you what does not drive volatility. Weather drives volatility. Think about the impact of Mother Nature. When something like that occurs, obviously you're going to be pulling capacity into there to be able to rebuild and provide support and food, etc. Government regulations. I talked about the OPEC moment back for oil in the 80s, and in government regulations in the transportation space has really occurred very significantly. Obviously, you can go back to 1980 for deregulation, but we don't have to look that far back. Look back into December of 2017 when the electronic logging devices, ELDs, became a requirement. They weren't enforced fully until April of 18, so less than a year ago, but that government regulation clearly had an impact. Some of what we saw in that run-up of spot prices back in the May, June, July timeframe were the run-up of trying to get ahead of any tariffs or trade policy impact. So I won't go through all of these pieces. Seasonality. There's going to be a produce season in Northern California, in the southeast of the United States, in the Pacific Northwest, when apples and Christmas trees are occurring. How do I protect myself from these volatility drivers? So you might say, well, sure seems like this was a good idea. I'm surprised no one's done it previously. Yeah, you're right. Why now? What is going on now? I talked about it a little bit. The ubiquitousness of these. If this had been a great idea back 15 years ago, these were dramatically less capable of providing data and telematics information within a truck to be able to have there be that transparency, to be able to give information to all of the user community about what's going on and what I should be doing from that data that I'm able to analyze. The telematics, that data now goes into the cloud, means that it's no longer sitting on somebody's server over at company A, but not on another server at company B. Now we've got it in the cloud. We can share it so that those systems can be interconnected and can be interconnected again back through and to these mobile devices that we've got. The market forces, I talked about the ELD mandate and the regulatory impact of what's happened right now and how that's affected the market and will continue to affect the market going forward. The impact of the labor shortage. I'm sure that everyone on all sides of the transportation spectrum respect the fact that the truck driver's job is a challenging one, is a difficult one, and there is a constant struggle to deal with that labor shortage. We talked about trucking growing faster than GDP does. One of the reasons the trucking transportation freight has been growing faster than GDP in that recent time is the fact that every one of you expects that if you go onto Amazon Prime, that whatever you order is going to be at your house within either today or tomorrow. Well, the Amazon or the e-commerce impact of those last miles are certainly having an impact and causing, if you think about it as a domino effect, are causing and caused a significant challenging capacity crunch in 2018. So let me talk a little bit about what I would expect most of you in our group today are working from. But before I do, no truck will ever show up. It's an old sales thing. Tell them what you're going to tell them, and tell them what you told them. So that's 3 times I've said it. So you think you might be safe that I won't say it again. But that may or may not be true. So what types of companies are going to be exposed to freight volatility? Obviously, trucking companies. Okay, trucking companies are exposed, but how many of them could be industry participants and be interested in this kind of offering in the freight futures contracts? There are 4,500 companies, trucking companies, that have greater than $20 million worth of annual revenue. All plenty big to be in this marketplace. Shippers, like AB InBev. And let me stop quickly and say, when I say shippers, if you're from the financial community or outside of transportation, you might think shippers. You mean the big boats like with containers all over them? No, shippers as defined by folks like AB InBev, people who manufacture things that need to have them then transported, or distributors who need to use trucks to transport their things. That's what shippers are, and there are 20,000 shippers that spend $10 million or more. Again, plenty of scale for each of them to participate and have exposure to volatility that they'd want to make sure that they could take out of their budgets. And what's in between those carriers and those shippers? Freight brokers, intermediaries, 3PLs, 4PLs, however you want to define them. There's more than 1,600 of those freight brokers that have more than $10 million of revenue per year. So 4,500, 20,000, 1,600. I think we've defined that within just the industry participants, there's plenty of opportunity for liquidity to happen. So kind of summing up a little bit before we move on to some of the more specifics around what's going to happen in within the market contracts. What is required? What do you need to build a liquid futures market? A large and volatile market. By the nodding of the heads up and down that I see even late on this afternoon, with me and my cohort standing between you and an AB InBev product, I see you're shaking your heads and say, yep, large market, and yes, obviously volatile market. You need a benchmark index. DAT, I talked about them when we looked at the volatility slide. They are the Platts of this industry, the trusted index that will settle against. You need the exchange and clearinghouse, which is what Nodal is providing. We'll give you a little bit more depth and background here, a little bit about them. And then you need to have a provider of the transparency necessary to make all of this work. And that's where FreightWaves, in providing market data, news, and insights, plays our role. And to put it into final perspective on the size of what these contracts will be, so we talked about $750 billion. I dazzled you with almost $1 trillion worth. I dazzled you with almost $3 trillion worth of the volume when it trades in multiples. But let's talk about the real world number, where we think that the number could be, if you looked at it, could be traded relatively easily. I talked about the difference between contract and spot. Take my nearly $750 billion and take out less than truckload, but just think about the spot market. Spot market, like I said, somewhere in the vicinity of 15, 20%. We think that spot market, represented by approximately 40 billion miles, and utilizing then 1,000 miles per contract, you're looking at 40 million futures contracts that the spot market, that exposure that exposes the shippers to a potential dramatic, potentially significantly impactful, catastrophic impact to their bottom line, a major impact to you intermediaries and your net to gross. And on the carrier side, you've got those assets that you're trying to pay off, and you want to make sure that you are protecting your dollars, your productivity, and your daily productivity. That's what this has the opportunity to do. So with that, if we get this to move on one, I'm going to hand it over to Tom Mallon, and Tom's going to speak more to the specificities around the contracts and their highlights. Tom?
Thank you, George.
I'm going to take my ubiquitous.
So I want to spend a few minutes talking about the futures contracts themselves. But first, before I get into that, I just want a little bit of audience participation. First, question that I have is, what is never, ever, ever going to show up with these futures contracts? Thank you very much. The second, just so I get a sense for who's in the audience, I mean, how many here are shippers? By show of hands. Carriers? Okay. Intermediaries? Okay, mostly intermediaries. And others? I got the others. Perfect. Well, thank you very much. So, anyway, these contracts, as we said, they're cash-settled contracts, and we worked with our partners, DAT and the Nodal Exchange, to come up with a set of contracts that are representative not only of regional risk, but also of national risk. And so our partner, DAT, as George alluded to, is essentially the benchmark assessor in the industry. And he referenced the word Platts. Well, if anybody is familiar with energy, the primary assessor of pricing in the energy world is Platts. So they are akin to Platts in the trucking world. Our partner DAT, they do assessments on a daily basis. And on a daily basis, they're assessing roughly 18,000 origin-destination pairs, OD pairs, from which we were able to work with them and Nodal and narrow it down to 7 defined lanes across 6 cities, which will comprise the futures contracts that we're going to create. So in the West, we've got lanes between Seattle and LA, LA back to Seattle, and we take those 2 lanes and average them to create a West Coast average. In the South, we've got LA to Dallas, Dallas back to LA, the average being the southern basket. And then in the East, we've got the triangle, Chicago to Atlanta, Atlanta to Philly, Philly back to Chicago. And that would comprise an Eastern average. And from those baskets, we've created a national average. So up to 11 contracts could be listed for trading on the Nodal Exchange come March 29th. And the reason why we selected these lanes are they are extremely liquid, meaning there are a lot of dry van loads that are moving on a daily basis along these lanes. So there's not one carrier that is going to be dominant in terms of freight moving along these lanes. A little bit about the contract specs themselves. As I mentioned, we've got 11 slated for launch. We've got the 7 individual lanes spread across the 6 cities that I referenced, the 3 regional averages, and the national averages. Again, these are cash-settled contracts. They are monthly contracts. You will be able to trade these contracts out 16 months. So you will be able to manage your risk and exposure up to 16 months forward. They are based on dry van, so there is no flatbed, there is no refrigerated included in this rate. Also, there's no fuel charges or any accessorial charges. These are the actual line haul rates that are charged to move freight along these corridors. They are marked to market on a daily basis, meaning that they are settled on a daily basis. The settlement process on a daily basis is based on trading on the Nodal exchange. So any trades, bids, and asks that are put into the market will be taken into account for that final daily settlement price. The final monthly settlement price is based on DAT's monthly settlement average. And what that is, they are doing a daily assessment, which we will be publishing on a daily basis in our FreightWaves Sonar platform. On a daily basis, they will publish that price, and the final settlement price for the month will be an average of DAT's daily settlement prices over the course of a month. As George mentioned, the contract size itself is 1,000 lots, 1,000 miles. That's the size for a lot. And as I mentioned, the contract series is 16 months, so you can manage your risk out to 16 months forward. Also, we've had a lot of questions about other types of instruments. We're only listing futures contracts, monthly futures contracts. We are not listing options day one. A little bit about our index provider, DAT. As I mentioned, on a daily basis, they're assessing about 18,000 origin-destination pairs. But on an annual basis, they're collecting about 256 million electronic transactions, which comprises about $60 billion worth of freight. So a very huge market assessment that they do on behalf of us. And now what I want to do is just give you a quick sense and flavor for how these contracts could be traded. This is illustrative. This is not actual trading, but I just want to give you a sense for how they could be traded on a screen. So what I've pulled up here is our Sonar platform. Within the Sonar platform, we are going to embed the capability of trading futures contracts. We will actually provide a link from Sonar to CQG's trade matching engine, which is the platform that is being used by the Nodal exchange. So what you see here is some market data, within Sonar. If I want to go trade, I'll go into my simulated trading platform and bring up a trading screen. Within my trading screen, I can look at a couple of things. So I've got an order book. It's not yet published because I haven't selected anything. But I also have market data. And in this case, I'm looking at the national average. If I want to look at other averages, I would go into my market section in the middle. There's a drop-down box which brings me up the contracts which would be available for trading. And in this simulation, I only have the national and the 3 regional averages. Let's say I'm interested in trading the East, as an example. I would select the East average, and then down below are the actual contracts that are available for trading, and as I said, they're monthly contracts. Up on the top, and you'll hear about this in a second, is information about my account. Now, in order to trade a futures product, a trucking freight futures contract on the Nodal exchange, 2 things have to be done. Number 1, you have to become, or your firm has to become, a member of the Nodal exchange. And then secondly, you have to establish a banking relationship or a clearing relationship with one of 12 banks that are approved by the Nodal exchange to support clearing. So you have to do those 2 things in order to trade trucking freight futures. And since we're launching on the March 29th, If you're very interested in trading, you have to do that now, and we'll provide information on that to anybody who wants it after this presentation. So up at the top, what you're seeing here is information about my account that has been set up by my clearing members. So I've got a nice balance of almost $100 million. I wish I had that balance. But also I can track my daily P&L and my overall profit and loss for my trading activities. So in my scenario here, I'm going to take the perspective of a shipper. And so if we look at our data in the East, so this is the DAT Van Freight Rate Index for the East, we've seen over the past few months that rates have collapsed. And so if I'm a shipper, I am concerned about rates rising. And as we can see here at the end of the chart, rates are beginning to rise. So in my hypothetical example, I'm a shipper. I know I've got about 20,000 miles worth of freight that needs to be moved. So I'm going to want to go into the market, and I am going to want to buy 20,000 miles worth of trucking freight futures to protect myself against a rise in rates. So in order to do that, I would go into my order book. Let's say these miles are going to need to be managed over the month of March. I would select my March contract. The market data would then populate in my order book. If I wanted to trade, I would go to place an order into the market. As I say, I'm a shipper, and shippers are naturally short capacity. So they're fearing a rise in rates, which would be operationally bad for them. So in this case, I'm going to want to buy 20 contracts. Remember, they're 1,000-mile increments, so I'm buying 20,000 miles worth of futures contracts. I'd place that order into the market by hitting the buy button. Up top, I get a confirm that my order has actually been executed. And then down below, you'll see that I now have a position. It says I'm long 20, which means I have bought 20 contracts. And so now I own 20,000 miles worth of futures contracts. As my freight begins to move, I'm going to want to unwind my hedge position. So in order to unwind my hedge position, I would go back into the market, the March contract, which is highlighted there. I want to place an order into the market, and in this case, I want to offset or sell 20,000 miles worth of futures contracts. I sell that back into the market. I get my fill up top, and then you'll see my position down here is there is no position, which means I sold my 20,000 miles worth of futures contracts, and I'm now flat. And so that's one hypothetical example as to go about achieving a hedge from a shipper's perspective. Now what I want to do is just run through a couple of very high-level use cases that will highlight, how futures contracts can be used to hedge exposure from different perspectives. So I just talked about the shipper, again, and his exposure. A shipper, again, is naturally short capacity, which means the shipper is afraid of a market where there is going to be rising rates. That is going to hurt them because they're going to have to go to the spot market and pay more for capacity. So to offset a rise in rising rates, a shipper would naturally want to buy futures contracts. So any loss in margin because of rising rates would be offset to a large degree by the profit that would be made on the financial future that had been traded. So operationally, there is a loss. Financially, there is a gain. The two offset each other, and that's how you achieve a hedge or your goal. A 3PL or an intermediary, they technically can be exposed to both, the long side or being short capacity. They can also be exposed to being long capacity. Generally speaking, though, a 3PL or an intermediary looks more like a shipper, where they're looking for capacity. And so, again, their biggest fear in the market would be an increase in rates. So, again, just like a shipper, they're short capacity in the physical market, so they would want to be long or buy futures contracts in the financial market. Again, the operational loss that happens in a rising rate environment, therefore, would be offset by a financial gain based on the profitability of the futures market. And then the carrier perspective, opposite of the shipper. The carrier is long. They are long capacity. So their fear is a drop in rates. So from this perspective, in order to protect themselves, a carrier would want to naturally sell futures contracts or go short. Thereby, when the rates start to decline and they need to go into the market to buy freight at a lower rate, it's offset by their profit, because if they're selling a futures contract, they want rates to decline. That way they're making a profit. Again, operationally, they experience a shortfall, which will therefore be offset by an increase on the financial side because of the declining rates. So that's just real quick, a couple of use case scenarios. And so, as George said, we'll be available to answer any questions that you have. Right now, I want to turn it over to Addison Armstrong. He's going to walk you through the role of our exchange partner, Nodal, and the functions that they provide to the marketplace.
Thanks, Tom. So, yeah, our partners from Nodal unfortunately couldn't be here today, so I'm going to take over the role of explaining the role of an exchange and a clearinghouse in a futures market. Before I do that, though, could I get a show of hands of people who are familiar with how a futures market operates? All right, so we got a good mix here. So I'll go slow, and as I said, we'll have questions at the end. So the Nodal exchange, there's two parts. There's the exchange and the clearinghouse. The exchange acts as the buyer to every seller and the seller to every buyer. When you enter into a futures contract, it's not shipper A and carrier B, being matched up in the market on a name basis. It's just a financial contract where the exchange actually stands between, and they are the seller to every buyer, and again, the buyer to every seller. The contracts are standardized, as you've seen. The only difference being price, or what month you want to transact in, and then whatever volume you want to trade. But the contracts themselves, one contract is 1,000 miles. If you wanted 20,000 miles of exposure, you would buy 20 contracts. So again, the Nodal is a derivative exchange that provides price, credit, and liquidity risk management to participants in the North American commodities markets. A little bit about Nodal. It was launched in 2009. It competes against exchanges like the CME and the Intercontinental Exchange in the energy markets. Nodal's specialty, interestingly enough, it was actually founded by participants in the electricity market. And one of the reasons why they were interested in partnering with FreightWaves, and we were interested in partnering with them, is that electricity and freight share a couple of characteristics. One, you can't store electricity, you can't really store freight, and they both move along grids. So conceptually, Nodal Exchange had some familiarity and some appreciation for the actual dynamics that could lead to the trading in this marketplace. The other part is the clearinghouse, which handles the financial settlement of the contracts. As a futures trader, as Tom mentioned, you need to have an account with a futures commission merchant, or an FCM. He mentioned there's 12 of them. Many of them are household names, some of the biggest banks, and then some independent firms. They act as, you have to deposit, you make a trade that requires you to deposit what's called margin, which is a performance bond on that contract. It's usually a fraction of the underlying notional value of the contract. So say one contract of freight futures, say the national average is, for the sake of argument, $1.50. So that means that contract is worth $1,500 on a notional basis. Generally, and we haven't decided yet exactly what the margin level will be for freight futures, but generally it's somewhere around 10%. So in order for you to be involved, to control that one contract, in this example, you would have to deposit $150 with your futures commission merchant. Now that amount is marked to market on a daily basis. So tomorrow, if your position appreciates in value, then you have a credit in your account. If your position were to trade lower, you would have what's called a debit, and you would have to then, you would have what's called a margin call. And you would have to then, the FCM would call you and say, you need to deposit X amount because your position went below the initial margin requirement. That's called variation margin. So as your position's moving against you, you have to post more margin so that to keep that level of initial margin in your account. Again, it's done every day on a mark-to-market basis based on the daily settlement of the contracts that you own. Nodal Clear also, they as a clearinghouse, they have the calculations that derive what the margin is. They use something called portfolio margining, which is different than what you may be familiar with the CME or ICE, who use a margin called span. And so what this really does is this really protects the entire market because they're acting as the credit counterparty. So you, again, as shipper A and carrier B, I'm not exposed to your credit. I'm exposed to the credit of the exchange and the credit or the clearinghouse. And the clearinghouse, of course, is backed by all of its members and the margin deposits that are at the clearinghouse. All of the futures commission merchants must also pay into a guarantee fund. So if there is a instance of default on the market, there is a buffer of collateral there that protects all the participants in the marketplace. I should say that Nodal Clear and Nodal Exchange are both owned by EEX Group, which is ultimately owned by the Deutsche Börse, which is a very large, well-established German exchange. And so it's very well capitalized, very, very well run. Of course, in North America, it's a smaller exchange, but again, it's backed by very substantial partners or owners in Europe. So here are the 12 FCMs that are members currently of the Nodal Exchange. There are 3 others that they're currently working to bring on. So you can see there's some household names here. You see Citigroup, Goldman Sachs, Merrill Lynch, Wells Fargo, Morgan Stanley, RBC, and then you have some independents. Well, ADM Investor Services, certainly in the commodities world, is a household name. BNP is a French bank. ED&F Man is a very old commodities broker, originally a sugar broker. I think it goes back to the 1700s. So all these firms, very well capitalized, very well established, very strong risk management procedures and processes. And again, to be involved in trading trucking freight futures, you must, 1, become a member of the Nodal Exchange, which involves filling out some paperwork and providing some KYC information, and you also have to have an account at one of these FCMs. I will tell you, having come from an FCM, that and there will be different levels of how long it takes to open an account. But if you want to be ready on day 1, on March the 29th, we need to get you talking to one of these FCMs right away. And because of my experience in the market, I have a sense of which ones will be faster than others, and we're happy to help guide you in that direction. In terms of, okay, so now you've got an account. You're a member of the Nodal, member of the exchange, which I should point out, just a membership, it sounds like you have to pay. There's no fee associated with becoming a member of the Nodal Exchange. Again, it's just a KYC requirement. So you've got your account, you want to trade, how do you do it? So there are a number of different ways. The Nodal Exchange itself uses a matching engine called T7, which is actually a product of Deutsche Börse and is a very low latency trade matching system. It's used by exchanges such as Eurex, EEX, and now the Nodal Exchange. Nodal also has its own trading platform, the T7 trading platform. So as a member of Nodal, you'll be able to, you can go right to the Nodal exchange and execute trades on screen that way. There's also the ability to block trade by using an OTC broker and potentially the execution desk at your clearing firm, where, and again, block size has not been determined yet. We think it's going to be 10 contracts will be the minimum block size, but you can call up one of these brokers and have them execute the trade on your behalf at a price that's relative to the market. So you see a price in the market, you say, I want to buy or sell at that level. If they can accomplish the trade then, or at that level, then they take that information, and they're the ones who actually inform the exchange and inform your FCM, and that position then shows up in your account in the run later that night and the next morning. We also intend to have, through our Sonar platform, for those of you who are familiar with it, you know, where we have data and analytics, as Tom was showing you, we intend to have a gateway where you will be able to trade directly through our platform. So it's either through a voice broker directly onto Nodal's screen or through our Sonar platform. For more sophisticated financial traders, there will be the ability to write APIs if they have their own systems or use other third-party platforms. So it's designed to be able to be executed however you choose. It's very flexible and very robust in all of those platforms. So with that, turning it back to George, and we'll have a Q&A session. I ask that if you have a question, just raise your hand. Again, we have this being broadcast, so we want to have the questions heard by our audience over the internet. So just raise your hand, and one of our colleagues will bring a microphone around to you. Thank you.
Question? Do we have a... Phil's got it.
Yeah, so...
Could you actually tell us name and who you're
I'm
with?
Alex Schaefer with ODW Logistics.
Thank
I
you.
was watching like your guys' stream in Chicago, and you mentioned that a third party would want to be short and long at the same time.
Mm-hmm.
Can you kind of explain that? We were kind of confused and would want to learn more about it.
Yeah, I think that was the intermediary scenario where you've basically got two streams of business. One being protecting your margins, and the other being protecting your costs. And so what I had actually just talked about was really protecting on the cost side in the scenario where you look like a shipper and there's falling rates.
Mm-hmm.
But you also have the other side where you've got exposure as a carrier, and again, it's the same type of thing. So you're protecting like a margin and your cost.
So is there I know with like Sonar, you guys, if we were to sign up for Sonar, you provide like analysts, people who can help you kind of learn how to use Sonar effectively. Is there a way to like, same thing with futures maybe, to train somebody who doesn't know a lot about futures?
That's not our role,
Okay.
but your FCM would be very happy to create and help you work through hedge programs. FreightWaves is not an advisor, so we're not going to advise people on how to trade futures.
Gotcha.
I just want to add to what Tom just said. That's really a regulatory issue, and we aren't registered as a futures broker, so we can't provide that level of advice. Even though on our platform there's analytics and data that you can look at, we can't actually say like you should do this.
Gotcha.
Thanks. Ed Dworkin with Logistic Freight Solutions. As far as liquidity goes, are there any market makers in place ready to start making markets right out of the go? Any incentives in place?
Yeah, we are in discussions, as you can imagine. We've got a month before the contract starts. We're in discussions with market makers, both from the industry, particularly a couple of 3PLs that are interested in making two-way prices, and also financial market participants, professional futures traders who see the opportunity and are willing to stand in the marketplace and make that two-way market. Thanks. It's a great question.
Hi, my name is Rob Cook with Share Logistics. Kind of on the same line that he was asking over here as well too. Without the market maker, with the market maker aside, I mean, is there an anticipation on the bid-ask spread on these things? They seem to be kind of high to begin with. Without that, I see you're smiling with that one, but
Well, we've had that question at several of our
Really?
roadshows, naturally, and particularly for anybody with familiarity with futures contracts. Tom's been in the commodities markets for a very long time. I've been in the commodities markets for over 20 years in a variety of different commodities, and I've seen a lot of different commodities launch. And typically, when there is a new contract, the bid-offer spread will be quite wide. But as we attract liquidity, and this is why these roadshows are so important, to come out and educate and try to educate the industry, so that we attract more participants, of course, because you seem to be a person with some familiarity. You know, you attract more liquidity, the bid-offer spread comes in. So we understand that, and in our role as being responsible for marketing this product, along with our partners at Nodal, we are very keen to have market makers, and we know that that's going to be important. In terms of sensing how wide it's going to be from the start, it's very, very difficult to tell. There are probably 3PLs in this room, people who work at 3PLs in this room, that can tell us better that, right now, what is the spread on the bid ask on a spot market contract for next month? That's probably where we would start.
And let me thank you, Jonathan. Just to sort of go into that a little bit and speak to it from the intermediary side, or more, that really across the spectrum. We looked at the volatility, where were spot rates in June of last year, and where are they now? Dramatically lower, significantly lower. If I had some freight that I was managing, I might actually try to take some of it out to the spot market, because some of those spot rates are actually lower today, where the spot market was absolutely what you wanted to avoid for most of 2018. So as Addison's describing, in the seats that, since most of you are from the intermediary world, you're wanting to think sometimes like a shipper, sometimes like a carrier. We have the ability, you have the ability now to look and see what's happening, and saying, okay, right now, if I could lock in some of those rates, as I'm trying to think like a shipper, I'm gonna lock some in, thinking about where my margin might be. But to Tom's point, on the flip side, well, wait a minute, now I'm trying to also think like I've got to go get my capacity. I've got to think like a carrier. That's where we think the liquidity is going to come from, and many of the market makers that we're talking to are, in fact, in the intermediary world. Anyone else? Lots more knowledge to dispense. More than happy to.
Thanks, Dan Connor, speculator. So the FCM account, is that a regular brokerage account, or is that a specialized permissioned account?
No, that's just a normal, futures account that you could open at any of those firms. I must point out, however, that there are, as in any futures market, there's a requirement called an eligible contract participant, or an ECP, which means that you have to have a certain level of assets, either cash or non-cash assets, that you can prove you have in order to be a participant in the marketplace. I believe it's right now the ECP standard is $1 million in cash, or $10 million in assets. There are also there are firms that are interested in becoming CTAs in this marketplace. So if you don't meet the ECP minimum, but you can deposit some money open an account with a CTA, they could potentially trade this on your behalf. There has to be some changes to the rules of the Nodal exchange before that can happen. They are working to change those rules. It won't be ready for day one. And I should just say that eventually we would love for this to be a retail product, but for now it's strictly a commercial product.
Oh, sure. Go ahead. Phil, right here.
Michael Preisinger from Ag Force Transport Services. Each unit's 1,000 miles.
Yep.
I get it. You're moving it 2,000. What's LA to Dallas? 1,500 miles. It's not 1.5. It doesn't matter, right? Just
right.
one. That's I'm buying it for just LA to Dallas. One unit doesn't matter that it means 1,000 miles, even though it's 1,500.
Right, but you're buying in 1,000-mile contracts.
Got it. So if I'm moving 2, I need to buy 3.
Right.
Gotcha.
Right.
Okay. I just wanted to make sure if you.
Right. Yeah.